The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to Optimum Solutions webinar about group term life insurance over $50,000. My name is Susan Warren, and I'll be your presenter today. And Sherry Dwyer is also with me while we talk to you about a fringe benefit that many of you may already have, or one that many of you may be considering adding to your cafeteria plan menu. Today we're going to look at the definition of group term life over $50,000, how to properly tax and report the benefit for group term life insurance, some exceptions to IRS rules and codes, what makes a plan equitable and fair so that you are not discriminating, the IRS uniform premium table that is key in the benefit calculation. We'll look at some examples of actual calculations. And finally, we'll talk about expanding your horizons beyond your employees and even offering group term life benefits to employees' dependents. Now, a lot of you call group term life insurance over $50,000 by a lot of different names. I hear some of you call it imputed income. I hear some of you just call it our fringe benefit. And some of you just know it as your life insurance benefit. So when I'm helping a new customer get set up, I find that I have to ask a lot of questions to determine if what the customer is talking about is actually the IRS's idea of group term life or something else. And the IRS's idea of group term life is an employer-provided life insurance providing a death benefit payable in a lump sum to the employee's designated beneficiary, as in the company can't be the beneficiary. Now, the employer carries the policy, not the employee or the insured person, like you would if you were to go out and buy your own insurance policy. And there are some special rules in the Internal Revenue Code that apply to how this employer-paid benefit is taxed. There is a special formula that always involves the employee's age and can involve years of service or pay or the employee's position in the company. And because of these factors, group term life insurance coverage amounts don't really allow for the employee to select exactly how much coverage they get, like you would if you went out and bought your own life insurance policy. Generally, there is a 10-employee rule for group term life insurance. The employer must provide the benefit to at least 10 full-time employees before the IRS considers it term insurance. Now, there are some special rules and considerations for small employers and seasonal employers who have less than 10 employees or less than 10 full-time non-seasonal employees. So if you fall into that category, you can research that and see if you do indeed qualify for group term life insurance under the IRS guidelines. Let's look at taxability of the group term life insurance benefit. The value of the employer-provided benefit up to $50,000 of life insurance coverage is excluded from an employee's income. The value of coverage over $50,000 minus any amount paid for the coverage by the employee after taxes should be included in the employee's taxable income. The benefit is taxable for Social Security and Medicare taxes, but not federal unemployment tax. Employers do not have to withhold federal income taxes on the value of the benefit, although they can if they want to. If the employer does not withhold federal taxes, then the employee must pay the federal tax owed when he or she files his personal return at the end of the year. You, as the employer, would need to report the benefit on the employee's W-2 in boxes 1, 3, 5, and box 12 with code C, and on Employer Forms 940, Part 2, lines 3 and 4, and Employer Form 941, lines 2, 5A, 5C, and 5D. So let's look at all of these forms in detail. Here are the W-2 instructions for group term life insurance for boxes 1, 3, 5, and box 12, code C. Now, I'm not going to read all of this to you, but you can see that the instructions also remind you to withhold Social Security and Medicare taxes, but not necessarily federal income taxes. The instructions also explain what to do for former employees like retirees, and we're going to look at that in a little more detail just a little bit later on in the presentation. So here is Form W-2. You would add the taxable benefit to box 1, federal taxable wages, box 3, Social Security taxable wages, and box 5, Medicare taxable wages. Then also break out the amount for the group term life benefit in one of the box 12 boxes, and you can see there are 4 boxes there in box 12, A, B, C, and D. And you would mark it with a code C. Now, this doesn't mean that you put it in 12C. You would put the letter C in the first small box here in box 12. You might have several items that need to go in box 12, like 401k, or there are any number of things that you might need to report in box 12. But you'd put the code C in the first small box, and then the taxable benefit amount in the larger box to the right. For Form 940, Part 2, Line 3, you list total payments to all employees, and the instructions specify that you should include fringe benefits that are part of your Section 125 cafeteria plan. Line 4 is where you list payments that are exempt from FUTA tax, and group term life is specifically listed in these instructions. And here is a look at Form 940, Part 2, lines 3 and 4. You can also see that line 4 has box 4B. that you can check to indicate that the amount on line 4 includes group term life insurance benefits. Form 941, line 2, lists wages, tips, and other compensation. And that's the same as the W-2 Box 1 amounts. Line 5A is equivalent to W-2 Box 3, Social Security taxable wages. And line 5C is Medicare taxable wages. 5D is our new, or relatively new, 941 box for those taxable wages over $200,000. And here is the actual Form 941 and the lines where you should be including the taxable benefit for group term life insurance. There is an exception when it comes to group term life insurance, and that is when you have a 2% shareholder of an S corporation. A 2% shareholder in an S corporation cannot be treated like a regular employee when it comes to group term life insurance over $50,000. A 2% shareholder would be one who owns either directly or indirectly more than 2% of the corporation's stock, so they would have more than 2% of the voting power. Now, you should treat this shareholder as you would treat a partner when it comes to fringe benefits, but do not treat the group term life benefit as a reduction in the shareholder's distributions. Also, it stands to reason that you should not discriminate when it comes to how you handle group term life benefits. You can't give this benefit and its special tax advantages to just your key employees. Specifically, you can't just give group term life benefits to highly compensated officers or owners. Your group term life plan is considered non-discriminatory as long as at least 70% of all employees benefit from the plan and at least 85% of the participating employees are not key employees, and all participants are deemed by the IRS to belong to a class determined to be non-discriminatory, and your plan is part of your qualified 125 cafeteria plan. Now, here is that famous IRS uniform premium table. Since it's life insurance, the table is based on the employee's age, and it gives a fair market value of insurance per $1,000 of excess benefit per month for each age range. Now, remember this. I'm going to say it again. It lists premiums per $1,000 per month for each age range. Because you're going to hear this again in just a few minutes, and it's very important in the calculation process. So having a copy of this table is the first step in making the calculations for the benefit. And step 1 in calculating the value of the taxable group term life benefit is to determine the total amount of an employee's group term life insurance coverage. And the coverage should be the aggregate total of that purchased by both the employer and the employee under this plan. Now, sometimes the employee doesn't make a purchase. Sometimes it's just the employer. But if both purchase, add them both together. probably the most common way that companies dole out group term life insurance coverage is by using a multiple of the employee's base salary. For example, your company may say that employees can have 2 times their annual salary, and the excess value over $50,000 will be an employer-paid taxable benefit. However, there is a wrinkle here if the employee's annual salary changes in the middle of that year. And for that reason, it's very common for group term life plans to contain a clause that the salary basis will be used according to the salary at a specific date in the year, maybe January 1, maybe July 1, but it's locked in at a certain date of the year. Another method for calculating group term life coverage is allowing employees to choose a number of thousands of dollars of coverage. For example, $250,000 of coverage. And it's also quite common for the employer to set a maximum amount of employer-provided group term life coverage per employee. They're going to limit that benefit. That's very common. So after you have determined how much group term life coverage an employee has, the next step is to calculate the amount of coverage in excess of $50,000. What is the excess benefit, or the amount of group term life over $50,000? Then divide that excess amount by $1,000. You need to know how much the benefit costs per $1,000, because remember, the universal premium table lists premiums per $1,000 for each age range. And then the next step is to determine the employee's age at December the 31st of the year when the benefit is taxable. Remember, this is a life insurance benefit, so it depends on the employee's age. Younger is cheaper. Next, you'll refer back to the universal premium table so you can calculate the value of 1 month of the excess benefit per $1,000 and multiply that by the number of thousands of dollars of excess insurance. And from that amount, you would subtract any after-tax contributions made by the employee from the value of the insurance. And finally, you would add the excess amount, the benefit, to the employee's income, withhold and pay Social Security and Medicare taxes, and report federal income taxes, Social Security, and Medicare, as we discussed earlier. So let's do a couple of real calculations with real numbers. Our first example is employee Erica. Her birth date is April 22, 1958. Her employer's plan provides coverage equal to 2 times the employee's annual salary, and that salary is locked in at January 1. So Erica's annual salary at January 1 is $65,000. Her employer does set a maximum of $125,000. And Erica is making a contribution of $25 a month in after-tax dollars towards the cost of her insurance premium. So we're going to say 2 times $65,000. So 2 times 65 is $130,000, but remember her company set a max at $125,000, so that's the amount of her insurance. So we'll say $125,000 less $50,000. So her excess benefit is $75,000. How many thousands? We'll divide 75,000 by 1,000. She has 75,000 that we're going to charge her a premium on. We need to find out Erica's age. At December 31st, she'll be 59 years old. We'll go to the universal premium table and find her age range. Here it is. I just copied it from the table. Her premium per $1,000 is 43 cents a month for her age. So 43 cents times 75 gives a benefit, a taxable benefit of $32.25 per month. But Erica pays $25 out of that in after-tax dollars. So we're going to subtract that from the taxable benefit. Erica has a taxable benefit of $7.25 per month. Now, if you want to calculate her per pay period amount, you would multiply this monthly amount by 12 and divide it by the number of pay periods. So if she's paid weekly, you'd multiply this by 12 and divide it by 52 so that you could get a per pay period amount. And that's actually what we recommend that you do so that you can collect Social Security and Medicare on a per pay period basis. So if Erica leaves you in June or July, you have gotten up to date. You're not behind in Social Security and Medicare. And if she leaves you in the middle of the year, you're not left holding the bag. Let's look at another calculation. Erica was relatively young, but Bob is considerably older than Erica. Bob's date of birth is July 2, 1937. And Bob's employer's group term life plan provides a coverage amount of $200,000 for Bob's length of service and his pay. And also, Bob does not make any contribution toward the insurance premium with any after-tax dollars. So we're going to find out the excess benefit for Bob. We're going to take $200,000 of coverage and subtract the first $50,000. That's $150,000 of excess coverage divided by thousands. There are 150,000 to be multiplied by the universal table premium for Bob's age, which is $2.06 times 150,000. So Bob's monthly benefit is $309 per month. And again, you could multiply this by 12 and divide it by the number of pay periods in a year to get a taxable per pay period benefit for Bob. But you can see that Bob's benefit is going to be a significant taxable benefit because of his age. Former employees can be handled just a little bit differently. For example, if you continue to pay retirees and you continue to furnish the group term life benefit, you do not have to withhold and pay over their share of Social Security and Medicare taxes. However, you should report these taxes as uncollected on the former employee's W-2 in box 12 with codes M and N respectively as uncollected Social Security and Medicare taxes. You can also make group term life benefits available to your employees' dependents, their spouses, and children. And if you do this, the value up to $2,000 is not included in the employee's income, as it would be considered de minimis. However, dependent group term life coverage in excess of $2,000 must be included in the employee's taxable income using that IRS uniform premium table. And if you don't know the dependent's age, then you'll have to use the employee's age when you go to the uniform premium table. And remember, you don't have to withhold federal income taxes on the taxable benefit for the employee's group term life. However, any group term life benefit for dependents is subject to federal income tax withholding and Social Security and Medicare tax withholding, minus any amount paid by the employee with after-tax dollars. So like Erica did in our Erica example, if the employee pays for their dependent group term life insurance coverage with any after-tax dollars, you would, of course, subtract that from the employer's benefit, and that's going to make a difference in their taxable benefit. We want to thank you for joining us today, and we hope that you've learned some tips about taxable benefits for group term life insurance over $50,000. Please be on the lookout for more of our educational webinars soon. If you have any suggestions for webinar topics, we want to satisfy what you're curious about. And you can always email your suggestions for webinar topics to me. Here's my email address. It's swarren@optimumhris.com. And we'll take your suggestions and consider them and hopefully satisfy some more of your curiosity. We hope you all have an optimum day, and thanks for joining us.